What is going on, everybody? It's your boy Really Vici here for another video. This one's going to be covering a general concept called mitigations. Now, I didn't want to get too complex with this because a lot of people get stuck up on this and end up overthinking this way too much. When we simplify the trade plan and we make it super, super easy, um, like you're literally just gonna have to fall within that criteria of what's placed in that trade plan and just follow the trade plan to the T and nothing else, nothing more. So we still have to teach you guys these general theories because we're going to be talking about certain things. We're going to be looking for certain things, trying to identify certain things. You need to know what that is exactly, right? So when a level of, as you can see over here, when a level of supply or a level of demand is created through some kind of break of structure. Just pretend this is all bear structure coming back up to the upside, right? Pretend there's one more break over here. When this is all created, right, it creates levels of uh, demand or of supply, and originally they are unmitigated, as in like price has not come back. A mitigation is just price expanding, leaving some kind of level of supply or demand, and then coming back and then interacting with the zone, right? Because you have to understand again from the beginning how supply and demand works. There are pending orders within here that is going to push and kind of have that fair exchange value and then end up pushing price higher, trying to continue in its intent direction. This is an area where there's a lot of pending orders, right? So the market is going to want to gravitate toward where there's pending orders, right? Or there's people willing to put orders or inject a certain amount of orders into the market to be able to kind of move the market in its intended direction. So coming back into this area over here now, right? And this, let me just erase these lines quick. Every time a level of supply or demand is created, or you have a break of structure, normally there is some kind of unmitigated. And like when we look for supply and demand zones, we're gonna always look for the mitigated route, right? But you have to also understand what is mitigated and what is unmitigated, right? Unmitigated, for example, would be maybe because at the end, let's say this is a higher time frame POI. This is 50-minute structure over here, okay? And you have all these areas over here mitigating itself, right? Now price has to come back in and have some kind of retracement in this over a larger leg, right? So price is going to come back down, but all these POIs have been mitigated at that point. So when you get into the liquidity concept, you're going to understand that things like this, like tightly mitigated price action, later on ends up becoming inducement or liquidity via a trend line, for example, in this situation, and then we'd be looking for some kind of unmitigated PY. In this case, let's say refinement, and that's kind of how we kind of map out mitigating and unmitigated areas. You just have PYs that have not yet been interacted with or have come back in and tapped back into by price reaching back in and interacting with them, right? So what's happening over here, for example, had price gone like this and for some reason reacted to a low or some kind of external liquidity, came up and then just barely tapped over here. This would have been mitigated or partly mitigated had it started to break down again, right? And then put in a new low, right? Maybe there would have been something above here, whatever. That's not to be said in this type of scenario because we're not talking about that specifically. But at the end of the day, in order for something to be unmitigated, it needs to leave a level of supply or demand without price coming back after it's had expansion away from that zone and mitigating back and interacting with it at some kind of way, shape, or level. Now, there's also partially mitigated and fully mitigated, right? Like, for example, if you come over here, let's say you have like a flip zone, here you have an extreme, because you guys learned that in the last module, right? In order for me to say something is mitigated, first of all, this comes in and respects the flip, right? So when it's over a leg, I have the extreme here still unmitigated, right? Because price now ends up respecting the flip and ends up putting a new structure high. So now I've had this demand level left unmitigated within here, right? So now if price were to come back down, and I'm looking for something where I might expect some kind of strong reaction or maybe some kind of opposing side resistance is going to be these unmitigated zones depending on how structure is. If it's in continuation pro, you could expect some kind of strong reaction, maybe even a continuation back up. But if it's let's say this way bullish or sorry bearish and you're coming down, you may expect some kind of resistance on the way here, and then eventually breaking through on your higher time frame narrative, right? So that being the situation, we also have partially mitigated, where, for example, partially mitigated is like this, right? Where price comes down over here like this, puts in a new high, price comes in, just barely taps into the beginning of this PR. Let's say this is the PR right here. and then breaks above again, right? Now, depending on this leg forms up, depending on what happens here, depending on liquidity force, sometimes these type of scenarios is actually situations where price may want to come back into here later and mitigate the rest of it and have a full mitigation and eat up the rest of the pending orders. Use this as inducement or liquidity. Like I said, that'll be covered in liquidity concept videos, which is coming up with the next section, and it'll make a little more sense when we put it together, right? So, in order for a POI to be considered mitigated, the overall expansion of the whole POI has to be technically mitigated to at least the 50%, right? Now, validating which POI, what's valid, et cetera, et cetera. That's going to come putting everything together from the rest of the modules that are coming ahead with the conferences and the refinements. But for example, here, like even though I've come into this overall area over here, this is my last pivot on the higher time frame, right? On the lower time frame or on the medium time frame, I have some kind of refinement within here. So even though, for example, maybe this here comes and mitigates the 50%, which means this overall range has been mitigated, it doesn't necessarily mean it has to mitigate this little overall refinement, right? It's also imperative to understand what time frame you're looking at things on and understand that you're judging that based on the time frame that you have marked with the original POI and then your refinements thereafter, right? So this is all going to be coupled with liquidity concepts and where whatever inducement has to be taken into the POIs, et cetera, and how it develops coming back in. That'll be covered later on, and most likely through a live series. This type of stuff you can't really fit too much into videos; it becomes too convoluted. So for the time being, just have to remember when price comes in, comes back up, interacts with the zone. Before that moment, when price breaks down and price has not come back up yet, price just put a new low, had an expansion. Price wants to come back in now and first wants to interact with the zone. This is now starting to become the mitigation process. In order for it to be fully mitigated, you have to be roughly give or take the 50%, not necessarily 100%, could be a little bit less, a little bit lower. Most likely taking an all inducement within the POI itself. And then after that, mitigating to at least the 50%, right? So, same thing over here, as you guys can see, right? Price comes in like that, comes back, mitigates, goes to around the 50%. Sometimes it's more or less the same thing. Maybe there's some level of inducement here where it sweeps. Maybe there's some refinement within here. It doesn't quite actually come in and get the 50%. Maybe respects this refinement, comes just about there, but now it starts to break down. Price action starts to break down here on this time frame here, and now we have confirmation, right? That's been fully mitigated. Vice versa as well. When you come into here, unmitigated just means that there was no interaction with the zone at all. It's left fully unmitigated, and partially mitigated means it just tapped into the beginning of the zone, hasn't really uh, deeply mitigated the area, right? At the same time, in order for it to be a real mitigation on the relevant time frame, it has to be an expansion up and a retracement back into the thing. It can't be something like this where you're going like this, and let's say this is a time frame. Let me go like this 1 second. This is a time frame like this. Price creates a level of demand, and then price comes in like this and just does something like this on the way back up and continues. This is normally going to be used as inducement, right? It has to have a full expansion away from the thing, from the demand or the supply, has to then create a break of structure on the relevant time frame, then have to come back and mitigate on the relevant time frame for it to be valid, right? So that's about it without putting too much effort and thought into it, right? When we're going to be looking for our POIs, generally speaking, we're going to be looking for unmitigated areas or unmitigated POIs. So, for example, obviously, depending on liquidity gets created, but if I have a PY that comes down like this, right, and let's say I get a flip and it comes in, it pretty much fully mitigates here and then breaks down structure. Like now, would I really be looking for, I don't know, this little tiny sliver to really hold price for me? Would I realistically be looking for this overall flip, this unmitigated flip, maybe even a refinement in here that broke something on a specific time frame? It's unmitigated within this area. And obviously, I have to have like levels of inducement and all the stuff and proper price action come back in, sweep in to break down. Everything else is going to be covered in our criteria stuff later on. But I'm going to pick the unmitigated one, right? Most likely, that being the scenario. So I think that's about it for now. I mean, I don't want to cover too much. I don't want to put too much on you guys' plate. It's very simple, down to the point, and we're gonna cover it more on the putting it all together section, whatever it is, and we will break it down like that piece by piece, and hopefully be able to put it together for you guys like that one at a time. And I think that's about it for this video, guys. So I'll see you guys in the next one. Catch you on the other side. Thanks.